How's it going, everybody? Welcome back to the channel. My name is Jay, and today we got to talk about my $0 to $100,000 passive income portfolio. Because I logged in the other day and I didn't expect the results to be good. I've been paying attention to the market, but when I looked, one thing really stuck out at me as unexpected and weird. And what I found so weird is that out of the 4 funds I'm investing in that portfolio, NUSI, ticker symbol NUSI, the nationwide risk managed income ETF, is the worst performing of the 4 ETFs I'm holding. Not only is NUSI down over 10% year to date, but NUSI is underperforming QYLD. I mean, how is that even possible? If you remember, NUSI and QYLD both generate their income by selling covered calls against the NASDAQ 100 index. The difference is that NUSI purchases put options against that same index to offer downside protection to the investors that QYLD doesn't offer. So we've been in a down market. NUSI is supposed to be offering us downside protection. Where the is it? I mean, how does that even make sense if the fund supposed to be protecting us in a down market is underperforming the one that doesn't provide any protection in a down market? And the answer to that question lies a little deeper in the details of how QYLD and NUSI both operate. So let's take a look at exactly what the heck is going on here and figure out what's happening. And we'll start with QYLD. As we know, QYLD sells at the money 1-month call options against the NASDAQ 100 index. Now the numbers I'll use here are just for simplicity's sake. I don't know the exact figures, but the premium QYLD is collecting on selling those at the money 1-month options is about 3%. Of that 3% options premium that the QYLD ETF is collecting, QYLD distributes 1% back to us shareholders in the form of that dividend we know and love so well. And the remaining 2% of the premium they're collecting every month, they reinvest back into the fund. And they do this to compensate for the months that QYLD is down and to generally prevent the fund from collapsing. NUSI, on the other hand, sells its call options out of the money. So while we know that this leaves room for capital appreciation in the fund, it also in turn brings in less premium. So again, for simplicity, let's say NUSI receives a 1% premium on selling those out of the money calls. With that 1%, NUSI still has to purchase the protective puts it uses on the downside. So say 0.4% is going to purchasing those puts. That leaves a 0.6%. That leaves the 0.6% as the distribution that NUSI will use to distribute back to its shareholders in the form of the dividend. The NUSI ETF typically has no excess call premium to roll back into the fund. Another important piece of information, and one we may overlook, is about those puts that NUSI is purchasing. They are downside protection, yes, but they should be more looked at as crash protection. And despite what any number of YouTube thumbnails might tell you, we haven't experienced a market crash. If you look back to March 2020, when we had that large market crash, NUSI performed extremely well in that scenario. That's because typically those put options that NUSI is purchasing are designed to prevent against a steep, sharp, single-day drop. Nationwide even states so much on their website under the section for NUSI's performance in a declining market. In their second bullet point, they say, the fund may, however, underperform in this environment if the positioning, i.e. strike price, of the portfolio hedge exceeds the magnitude of the market decline. So what they're saying there in simple terms is that NUSI is going to underperform when the strike price of those puts is much lower than the decline we're seeing in the actual market. And that makes sense. If the strike price of the put is lower than how far the market drops, it may as well not even exist. So let's look at an example using real numbers. The current level of the NASDAQ index is 13,548. So QYLD would sell calls 1 month out with a strike price of 13,548. For simplicity's sake, they would receive a 3% premium in doing so. They'd return 1% back to you and me in the form of the dividend, and the remaining 2% they'd roll back into the fund to offset against any losses. NUSI, on the other hand, would sell their calls at approximately 14,000, we'll say for example, and they'd receive a 1% premium back in turn for doing so. Then they'd take 40% of that 1% and purchase put options at, say, the 12,750 level. The remaining 60% of that original 1% they distribute back to you and me in the form of the dividend. So you can see NUSI is leaving room for capital appreciation up to that 14,000 level where QYLD doesn't, but QYLD is rolling excess premium back in the fund to keep it afloat in down markets where NUSI isn't. NUSI usually doesn't have the extra premium to do so because it's buying that protective put to guard against a sharp and sudden drop in the market. So in a slightly up or in a violently down market, we will see NUSI outperform QYLD. But that's not our current market. Our current market has been more of a slow and steady bleed downward, and that leaves NUSI vulnerable. And because QYLD is rolling a portion of the call premium it receives back into the fund each month, that is why we see NUSI underperforming QYLD, even though we all know NUSI has downside protection built into it, which would make many of us believe it should be outperforming in the current market. Now, if you want a deeper dive into what QYLD or NUSI are all about, check out these two videos right over here. I go really in detail on both of them. I hope this video helped you out. Give it a like if it did. Thanks for watching. I hope you enjoyed it, and I'll see you in the next one.